traders from across the globe. Welcome to 2023. I'm so excited. It's going to be a great year. In fact, you know what, kids? We are 2 full years away from that nasty COVID. It is time for us to have a great year. I don't care which way the markets go. We're going to have a great year personally. Rock and roll, people. Now, when it comes to trading, you got to be careful. You got to put your stops in. It's a very risky game. I'm going to show you some great stuff for this year, at least for this week. And know that it's a risky game, okay? Never, ever trade without stops. If you made New Year's resolutions, don't kid yourselves. Nobody keeps them. Stop making them, silly. And for everyone else, just follow the rules. You don't need a resolution to follow your rules, right? You might need to slap your hand a few times, but you don't need a resolution. All right, so let's get moving. This video, 2,511th installment of Live with Oscar's short-term trading, if you want to call it that. It's coming at you for trading on the 4th of January, 2023. That's a Wednesday. Traders, it is exactly 1 year, 364 days from when I gave you a video exactly a year ago on the 4th. Let's see. I did the analysis on the 4th, January 4th, 2022. Came out with that video on the night of the 4th, so it was dated the 5th. All right, so we're off by a day. But within a day of a year, last year to the day almost, I gave you a video. And in that video, I said, look, we've been going up for the longest time, right? The market was at the highest it's ever been. The S&P pegged its all-time high. And I came out with a video to say, that's it. Now we start to go down. The first video of last year, 2022. I'm here to tell you that 1 year later, the technical picture is no better. Traders, I want to start with this. Humor me for a moment. I took a little clip out of last year's video so that you can see where this began. Humor me for a moment, and then we'll come back to present times. While at the same time, it makes the stock market have to adjust down in price. Why would that be? If the stock market's made up of corporations, big, huge ones, those corporations sell forward corporate bonds, monthly bonds, quarterly bonds. So you give money to a big company, Goldman Sachs. They use that money for a month to pay their monthly overhead and run their business, and they promise you X amount of interest of return at the end of the month. Those are monthly bonds. Those are how corporate bonds are sold. If at the end of the month of the quarter they owe you 5% interest, great, you get your 5% interest. That's why you would buy a corporate bond instead of a U.S. bond that has low interest. Well, if U.S. bond interest goes up, the 10-year, 30-year, the interest that you get if you buy a bond goes up, well, these companies then have to offer more interest for their corporate bonds. That means they're paying more money for the same amount of money, which means their stock feels it in price and must adjust. In layman's terms, I hope I didn't confuse you, but that's what will happen. So you've seen that clip, traders. I came right out on the first video of the year and said, that's it, the jig is up, and down we went. Now that was technical analysis, firing on all 8 cylinders. Doing my homework for tonight for trading tomorrow, Wednesday, the 4th, it doesn't look any better, I'll tell you that right now. The OMNI actually did go neutral, right? We have a neutral OMNI for trading S&P and NASDAQ for trading on Wednesday, but there are some interesting setups out there that we will take if they occur, because there are flags all over those charts, and if we get to the top or bottom end of a flag, we will react, but we're going to start off with a neutral OMNI for trading E-mini S&P NASDAQ. That's for short-term trading, but let's read this board. 1 year later, technical picture is no better. The charts will prove that to you, I promise. That's E-mini, S&P, NASDAQ, Russell, Dow, Transportation Average. They don't look any better than they did last year. Number 2 on the board, the dollar index and bonds are helping to push the market lower, the stock market. Why? Lower dollars and rising interest rates. It's a recipe for lower stocks. And in fact, if you watch that entire video, I explained the whole kit and caboodle to you why interest rates moving up would make the stock market go lower. So take a look at that clip or watch the entire video from last year. We'll leave a link to that video below this one. So, dollar index and bonds are helping to push the market lower because lower dollar, as it's been going lately, and rising rates is absolutely a recipe for lower stocks. It creates lower value of those stocks and the prices have to adjust lower, so we're in for a little bear market here. Number 3 on the board, OMNI applications are being accepted, traders. I've got 3 open seats only, February 2nd through the 6th. It is coming up soon. It's a month from now. If you want to join me here in Las Vegas, this is a 5-day extravaganza. You come in on a Thursday night. We work together all day Friday, Saturday, Sunday, Monday, and you leave Tuesday morning. That is intense. I will teach the OMNI to you right here in my home office, but I'm only going to teach it to 5 people. There are 3 open seats. Call me, 702-629-4755, or go to OMNIBootcamp.com and fill out an application, and I'll call you back. Do it now. OmniCamp is coming soon. We've got to make preparations for you. Call me or fill out those OmniCamp applications so I can teach you how to get this right before the entire year starts going crazy on us, right? You know it's gonna be busy this year, so learn how to read these charts properly so that you can make money in your trading account, or at least hopefully make money. So, number 4 on the board, which I was hoping to not have to talk about, but I don't have a choice. Number 4, do not fall in love with the upside is back. It is staying on the board until Jerome Powell says something else positive. Till then, that stays where it is. The technical picture is ugly. I'm going to show that to you right now. In fact, traders, boring filling out your OmniCamp applications and putting in your stops first. Let's go look at some charts. Traders, please remember to like, share, and subscribe to these videos, and let's look at this chart. This is your 30-year bond chart, the daily bar. It's been dropping for so long it doesn't even fit on the chart. It goes up into infinity up here, but it's been dropping. This is how interest rates go up when the bond futures go down, right? Dropping. And we had a little reprieve for a little while. If you remember, Jerome Powell came out and said, hey, we're going to back off our rates a little, blah, blah, blah. And the markets went straight up. But that has come to pass, and it's over now, and Jerome came back out and said he was just kidding, and down we go. And when bonds go down, interest rates go up. When interest rates goes up, that puts pressure on stocks. Then you've got the good old dollar. When any currency in the world is dropping, let's call it the dollar. If the dollar is dropping, the price of things are going up. That's called inflation. That, my friends, is what inflation looks like. Our dollar has been spiraling down, creating inflation. So if it costs more money to buy stocks and it costs more money due to interest rates for stock companies to lend out bonds, the price of stocks have to adjust lower. That's what happens. So let's go look at stocks now. Dow Jones Transportation average, well below the 200 bar moving average, below the 50 bar moving average. The street loves to look at both of these in a bear flag, which should move lower, or an Oscarism F flag, if you will, because it's slanted down a little. Either way, this points to eventually the market will head lower. Even if it gyrates up and down inside the flag and the flag grows a little bigger, eventually you're going to fall out of that flag and go lower, because that's what bear flags mean. So we are expecting, even if it gyrates up, we've got a neutral Omni to start off the day Wednesday, but if it gyrates up, you sell into the rallies, big rallies. E-mini S&P does not look any different. You are below the 200 bar moving average. You are below the 50 bar moving average. And here's what's interesting. You see this is a flag pole, bottom line of the flag, top line of the flag. Well, it's also exactly even with this 50 bar moving average. See that? Goes right through the top line of that flag. That shows you this is going to be resistance if the market can get to it. So we are selling rallies, and we have broken this major support right here, right? What held the market, held the market, held the market, held the market, held the market until it finally broke into a bear flag below the 50. That, my friends, is pointing to lower in the near future. And then we've got this. Russell 2000. Look at the size of that bear flag. Wow. It's pretty large. A lot of gyration room inside the flag, but lo and behold, that is a bear flag. So whether you move up or down in it, eventually you will move lower when you break out of it. So we are looking to sell major rallies in U.S. indices, expecting that these flags will pan out soon enough. And now we're going to go out to the weekly, because I'll tell you right now, the weekly charts have volumes of information, and they're spewing it out to us right now like fire hoses. Look at this. E-mini S&P weekly bar. This is really strong resistance when it builds on a weekly chart. Look at this red line. Really strong resistance. Knock, knock, knock. Epic failure. Epic failure that it didn't knock through that door and go through. Now it is moving lower in the form of what? A bear flag on the weekly. You got bear flags on the dailies. You got bear flags on the weeklies. This, my friends, is going at least down to the 200 bar moving average to retest that. Now, keeping the weekly chart theme in mind, look at this. This is chart masterpiece, in my opinion. Check this one out. The NASDAQ weekly bar has never broken the 200 bar moving average except for briefly during 2008. The only time it went through the 200 bar moving average, the 200 bar moving average was held even during the COVID crack. When we cracked in COVID, you still held the 200 bar moving average. If you follow this chart all the way back for 10 years, every instant you held the 200 bar moving average. Look here. The NASDAQ is below the 200 bar moving average in a channel on the weekly, heading in this direction. That couldn't possibly be a good sign. This is not a good sign. Even if it moves up a little, I am telling you now, we've got some downside coming this year. That's what's shaping up on the charts. Traders, I hope that helps. Make sure you join me at livewithoscar.com. And remember, at all times, keep your emotions out of trading and say this to yourselves over and over again. Stops are in. Emotions are out. Thank you for tuning in. Good luck trading out there on the